Now, every week on the show, we bring you our Investing 101 segment. Today, we're looking at investing in blue chip stocks. Joining me now is Dr. Andrew Dittberner, who is Chief Investment Officer at Cannon Asset Managers. Andrew, thanks so much for your time today.
Good evening, Siki.
What's a blue chip stock?
So I suppose blue chip stocks are, people refer to blue chips as being companies that have done exceptionally well over, recent history, and have elevated themselves in the South African market into the top 40 index.
Okay.
So essentially it's a large cap business, and the name comes from blue chips, the blue poker chips that used to carry a very high value. In gambling. So, that's where the blue chip comes from. And so people seem to think that a blue chip company is safe because it's very big.
Because it's very big, but we've seen companies fall into and out of the top 40 index. Can you give us a sense of the changes in that index, let's say, over the past decade?
Yeah, so conventional wisdom tells us that, big companies are safe or big is safe. That's not necessarily the case, and likewise that small is risky.
Yeah.
Small does not necessarily have to be risky. When you're looking for safe investment, you've obviously got to pay attention to the valuation. And then you've got to look at the business, at the balance sheet, history of management. So, big is not always safe and small is not always risky. But, if we look over time, to give us an example and to answer your question, going back to 1975, there are only 5 companies that have remained in the top 40 index since 1975 to today.
Wow.
So that will give you a sense of, the evolution of indices. And if we just think back recently we'll use the resource sector as a case in point. 5 years ago, the resource sector was constituted about 40% of the top 40 index, whereas today it's closer to 20%. So that's halved as resources have come under pressure.
Yeah.
And the industrials and 1 or 2 very large cap blue chip companies have done exceptionally well
and
over the recent history and pushed that resource exposure down. So just because a company is big doesn't make it a great investment, and it also doesn't necessarily mean it's safe. And I mean, there's a lot of examples to prove as such.
So let's talk about that assessment then, as one is building their portfolio. If you 10 years ago had invested in a small, let's pick a company that maybe 10, 15 years ago, during the resources super cycle that everyone thought would carry on forever, was not anywhere near the top 40 and has now crept in there, pushing out some of the resources.
Yeah, so I suppose a very easy example, if I had to pick a company that's come from nowhere, is Naspers, an industrial company that, 10, 15 years ago, no one had a few small assets.
It would go this way.
And no one had any idea where it would end up as it has done today. I mean, today I think it's the second biggest share on the JSE, or trading in the top 40 index rather. And they've had one great investment, which is Tencent, and it's done exceptionally well. And if you've been an investor in Naspers, you would have made yourself a lot of money.
Yeah.
Now, 10, 15 years ago, not too many people were looking at Naspers. People were looking at Anglo-Americans,
ArcelorMittal, even the construction companies, because of the World Cup that was coming up.
So exactly. So the construction companies, there's a few in there that we can talk about. Avenge and PPC are 2 companies that were in the top 40. Recently, we've seen PPC come under immense strain, and they've essentially, had to go to the market to raise capital and recapitalize the business. PPC, a few years ago was an angel of the market. And Avenge likewise, top 40, and now it's fallen through the top 40 index, mid-cap index, and it might have even fallen through the small-cap index. I think it's got a market cap of about 2 billion rand.
So here's a difficult question. How do you find the rising stars then?
So the potential exists in the small caps to be tomorrow's heroes. What we try and do is invest in tomorrow's heroes, not yesterday's. So because you're big doesn't mean you're going to be yesterday's hero. You can still get bigger, but the odds are you're going to find tomorrow's heroes in the small cap space. It's a lot easier to take 1 rand to 2 rand than it is to take 100 billion to 200 billion, for instance. So small caps are a lot more agile, which gives them room to maneuver, I guess. And but on the flip side of that, there also is the risk, and there are a lot more small caps out there, and small caps do tend to go to zero more often than a large cap does. But just because a company is a small cap doesn't mean it's a risky business. There's some fantastic small cap companies on the JSE at the moment that have balance sheet strength. They've got everything you want. They've got competitive advantages in place. But because of their size, institutional managers can't go there, because if you're managing 500, 600 billion rand of assets, you can't go and put 2% of your funds into a company that's got a 200 million rand market cap, because you buy the whole business and some. So, you know, a lot of these small caps don't get the attention that they probably deserve. And therefore there's a number of hidden gems, you know, on the JSE that's you know, your institutional managers aren't investing in. And for a private client or a person with an online trading account, you know, those are the perfect little shares that you want to be investing in. And hopefully they turn out to be an
And then one day they are absolutely blue chip. Thank you so much for your time today. Dr. Andrew Dittberner is Chief Investment Officer at Cannon Asset Managers.